And here's something also I think is pretty cool for people who are doing standard deduction. In the past, if you did standard deduction, you didn't get any benefit for your charitable contributions. But there's something new in this bill that actually gives you some benefit. And starting in 2026, retirees can deduct charitable gifts even if they don't itemize. So couples can deduct up to $2,000 and single filers can deduct up to $1,000. So it makes it easier to get a little bit of tax benefit for some of these contributions that you make to charities, even if you're not itemizing. To recap, for standard deductors, people who are taking standard deduction, originally back in 2024, it was $33,200 was the max. Now the new standard deduction could be up to $46,700, and then add another $2,000 in charitable contributions, which means potential total deduction is almost $49,000 for standard deduction. Now single filers over here, originally we had $17,000 was the standard deduction. The new one is $23,750, and then add on another $1,000 for if you do charitable contributions. That means the standard deduction has gone up to $24,750. Now, for those of you who do itemize on your taxes, the state and local tax or SALT cap has increased. It used to be that you can only deduct up to $10,000 for that SALT deduction. Now, moving forward, it's up to $40,000. So if you live in high tax states like California, New York, New Jersey, or Illinois, this is going to really help you because real estate taxes are often a lot more in those states. And one important thing here for this $40,000 limit, there is a modified adjusted gross income number of $500,000. So above that, it starts to phase out and reduce that maximum amount, and then eventually goes back down to $10,000 if you're making over $500,000. So if you itemize, you've got these things: the expanded SALT tax deduction, the mortgage interest rate as normal, charitable contributions, and then this new, on top of it all, senior bonus deduction if you're above 65. And if you're thinking about estate planning and legacy planning, there's been some changes there with the estate tax exemption amount. So before the bill passed, the estate exemption amount was going to go back to about $7 million per person, $6.8 million per person, meaning that your family would pay tax on anything above that amount. But this bill that increases the estate tax exemption to $15 million per person, or $30 million for a couple. So those are some of the highlights of the changes with this bill. Now, what should we do with this information? So here's the important thing. As I said before, the years 2025 to 2028, they create a very good opportunity or golden opportunity for tax planning. So here's 3 smart tax strategies or planning strategies to consider. Number 1 is Roth conversions. We've got a few more years of possibly better tax rates and also some of these extra bonuses over the next 4 years for people in their 60s. And then we've got this idea of where to take money from what account and when. And I would call this IRA withdrawal smoothing. So a lot of people really delay taking money out of their IRAs or 401ks, but it might make sense to use your traditional IRA more now for some income. And that way you'll start to have control over what the tax rates are, not knowing what they'll be in the future. And then also you'll have more control over your required minimum distributions as you get into your 70s, where we're actually they force us to take money out. And that all plays into your total tax efficient withdrawal plan. And it may be a good idea to actually talk to a professional to get help here. And then the last one is capital gains harvesting, and that is selling appreciated assets with little or no tax. There's